there. Who would have thought we would be anywhere close to an all-time high? But looks like we are likely to go beyond that, given that December is still left for the year.
Yeah, certainly. I think what we have seen. Can you hear me?
Yes.
Hello?
You please go ahead.
Yeah, sorry. Okay. So, thank you. Yeah, I think the resilience of the domestic flows, I think that has been the crowning glory for the year in terms of we have seen massive sell-offs in between by the FPIs, but the domestic investors continued to keep their faith in the markets, and here we are at all-time high or closer to all-time high. But I think, as your earlier gentleman on the show was mentioning, that it's the large cap indices which have reached the all-time highs, but your small cap, mid cap, they are, I think, a fair bit away. So the rally in the last few months has not been so broad-based. But my sense is that as confidence levels improve and maybe one more quarter of results from the domestic corporate India, maybe I think that should give the confidence to investors to invest in the small cap, mid cap segment, because the environment is very volatile and globally, whether interest rates hardening, recession, hard landing, soft landing. Also, China also has its own issues. So, in such an environment, it is natural for investors to gravitate towards the large cap, where the ability of these companies to manage the environment and survive and grow is much better. And many of the small cap companies may struggle, and which we have seen also in the quarter gone by, that margins pressure, etc., was very much evident. Ground level, possibly you are also getting a feel that there is some slowdown, etc. So I think investors are behaving very, very rationally with putting their faith in the large cap segment and taking a breather as far as the small and mid cap segment.
Exactly a year ago, there was a mad rush. Somebody called it gold rush. Everybody called it the new tech rush. Some also called it the new global reality rush. I'm talking about fintech. Nobody wanted to sell. Nykaa, Paytm, Zomato, Policy Bazaar. Today nobody wants to buy. The same guys who bought 50% higher, 80% higher, 90% higher are selling at distress levels. So was last year's price action more like a mirage, or this year's selling stampede is the ugly reality?
Thank you for asking this question. And see, I think we are hardcore public market investors, and many of the names that you mentioned basically were all driven by private equity and new technology, new money, or basically all digital driven businesses, where valuations, because liquidity was driving, and you invest at higher and higher valuations, small money, and you get a better valuation. And they IPO'd at the peak of the sentiment, where liquidity was at its peak and the sentiment was also extremely positive. But I think so the greed was what took all over all of us as far as the public market investors were concerned. But if you look at the investor profile, I think many of the veteran investors in the domestic ecosystem did keep away from many of these highly overvalued issues. There were some pop-ups which were available in some of these stocks, and smart investors were able to make some money off the table. And now when the lock-ins, etc., are being released, we see all the investors who are invested willing to sell stocks at maybe 25%, 30%, 40% from their peaks. So two reasons, I believe. One is obviously many of them are invested in so many other investments, and globally environment being difficult, they would like to take money off the table. And the second is the reality that there was a huge push to many of these internet-driven companies during COVID in terms of growth. Now things are becoming much more normal. So the growth which was expected to continue for many more years is getting more adjusted. Having said that, do these businesses have a right to grow? They are disruptive companies. Possibly some of them will get further disrupted by new entrants. But now, at least the valuations, with some of them having decent amount of cash on their balance sheets, all of them have started talking the language which we public market investors understand, which is path to profitability. Last year when these companies went public, I don't think so they were ever wanting to talk about what is profitability. It was only about growth and new segments and new geographies that they would like to enter. But now I think reality has sunk in, and they are talking about path to profitability. So some of these businesses are becoming attractive for investors to look at. But I think the herd mentality which is there, and today when these companies are available at kind of attractive valuations, investors are still not willing to bite the bullet.
Okay, there were sensible merchant bankers who took them public. There were big pension funds who talk about years and decades they've invested in them. And the same names are selling. So with all due respect, what I'm trying to ask, perhaps a question on behalf of our viewers who look up to these merchant bankers, who look up to these pension funds, who look up to some folks who are known for long-term investing, how has the template gone wrong so badly is I'm trying to understand. A stock may fall 10%, 15%, there could be business risk, but यहाँ तो गंगा उल्टी बह रही है.
See, I think I would not blame the investors who invested in those companies in the earlier years, or the merchant bankers who took them to public, etc. I don't think so. Any investor who invested in the stock when the company is IPO'd or subsequently to have any rights to blame any of those investors or the merchant bankers. It's a free market. All public information is available to you. You are buying because you believe that you will be able to sell tomorrow at a higher price or after 1 year. Now, if you have not evaluated the business properly, you as an investor are to be blamed for it. It is all about greed. It was about the bigger fool theory. Now, subsequently, if your bets have gone wrong, to blame anybody but yourself would be wrong. I think it's best that investors always consider about whatever the valuation. If they don't understand the business, don't invest. But if you have got it wrong, to blame anybody but yourself is totally incorrect.
Just wanted to understand, Morning, from you what the outlook is when it comes to the entire inflationary concerns, because you flagged off some concerns at the start talking about China issues, the global environment, and that big sword hanging over our heads continues to remain the inflationary environment. In light of that, going down the line, do you think that the consumption space as a whole, one needs to be a little bit cautious?
See, definitely, I think the global environment is very, very challenging in terms of, as you mentioned, about inflation, interest rates, China, etc. And it's going to be very volatile. I think that's the only thing that we know is that every day there will be some new data point which will come in, and which will possibly, whatever hypothesis you have a few weeks ago, again you revisit that. So I would think that investors, domestic India investors, who are investing in Indian companies should be more completely focused on domestic fundamentals, and based on that they should be taking investment decisions. Now, as far as consumer space is concerned, yes, there were headwinds in terms of high raw material input prices, and which was reflected in the margin pressures, etc. And there is a view that there is some slowdown currently also. So yes, you have to be very, very vigilant, but I think the raw material pressure at least seems to be going off. So maybe you will see margin improvement going forward. And most of the domestic consumption companies, if you look between staples and discretionary, staples, at least most of the company valuations are rich. So investors will also have to consider about the valuations in terms of when they invest. But then these, during inflationary times, generally it has been seen that they would be able to pass on, maybe with a lag or two, in terms of the raw material input prices moving up. So their profitability should be intact, and then also they are basically cash generating companies. So in an inflationary environment or a high interest rate environment, typically these companies tend to do well from an investor's perspective. So yes, we have to be very cognizant of the global headwinds, but more focused on domestic fundamentals and look to invest in these companies as part of your portfolio because of the inherently strength of the businesses.
It seems to be very divided, the opinion, when it comes to the PSU banks. Of late, of course, they've caught everyone's eye. But you seem to be of the view that the balance sheet are fairly robust, so you must be awfully pleased with how some of these PSU banks have performed.
Yes, see, I think in the last 3-4 years, I think the public sector banks have gone through total in terms of capitalization, in terms of cleaning up. So currently, there are tailwinds in the business. Credit growth is robust, and even most of these banks, public sector banks, should be able to participate in the credit growth cycle for the next few years. Also, I think generally the investor community and even the analyst community have been burnt by the underperformance of the public sector banks in the last 7-8 years. So their ability to thumb their desk doesn't seem to be there. So there are very few contra investors who are willing to take the bet and invest in the public sector banks. And some of the banks have delivered substantially higher returns on a 1-year or an 18-month basis. Now, for the next 2 years, do you think that public sector banks will give you better returns? I would say the odds are very, very high, because there is a lot of skepticism, and they have all the wherewithal to be able to deliver at par with the private banks. So yes, we are very positive on public sector banks.
If you look at the private sector banks, we've already seen returns of 15% plus. In case of public sector banks, it's upwards of 30-40%. So you're saying, despite this and the delta that exists, stay invested or maybe accumulate and prefer the public sector banks?
Yes, definitely. The valuations are still very, very attractive for the public sector banks, and there is no reason that on a 2-year basis they should. Most of them are quoting at say 0.5, 0.6 price to book, and many of them seem to be capable of at least reaching 13 to 15% ROE in the next 2 years. So our take is that as consistently on a quarterly, every quarter they deliver but good quality growth with minimal of credit cost, etc., then there is no reason why most of these banks should also start quoting at closer to 1-time price to book. And that should give you at least say a 25 to 30% or maybe more compounded returns on many of these banks, public sector banks, for the next 2 years.
Larger theme that is also playing out, and as we're going to start the new year, something that started this year. If you can look at PSU defense stocks, if you look at PSU fertilizer stocks, if you look at the PSU railway stocks, banking stocks, look at the kind of money that has been made. Is this a big PSU re-rating that is taking place, and is the market saying that outside of energy, everything of PSUs is safe and can be used for making money?
See, I think the way to look at this is that look at the various government initiatives in across the industry, and it's for not only the private sector but even the public sector units or public sector businesses will also benefit out of it. Now, whether you talk of defense or whether you talk of railways, the initiative that the government of India is taking in terms of growing those sectors, and the specific initiatives as far as Make in India is concerned. So many of the defense and railway focused companies should benefit, and market has recognized the opportunity. So I think, yes, there can be challenges, there can be flip-flops from the government, so investors do understand, but the sheer valuations at which many of these companies were quoting say 12 to 18 months ago, I mean, and the initiative that the government of India announced, and then look at the numbers that many of these companies are delivering. So investors have recognized that. See, I think we'll need to appreciate the fact that consensus trades never work. So 6 months ago, 9 months ago, many of these were non-consensus trades where investor ownership was limited. And as people got more and more comfortable, they have started investing, and now these companies should deliver decent returns. But if you look at it, the maximum gains have been made in many of these companies. But yes, going forward also, there is on a macro basis, the opportunity seems to be very strong, whether it be for the banking sector or for defense or for the railways. So yes, you should be looking to hold on to these stocks to decent returns even next year.
Okay. But KK, really appreciate your time and hope to see much more of you going forward.